So a lot of talk about the fact that there's no bearish strategist on Wall Street. Everybody's bullish about 2026. I want to get a sense of where you're at, because I can't tell if you're bullish or you're bearish, because you say next year is a year for normalization. What does that mean?
Yeah, so every turn this year we had something. We're ending the year with this silver story. I can't think of a month we didn't have something, show up that either caused volatility or really ran the headline strong. But 26, maybe we'll get some calm. I'm not quite sure, but I'm hoping for it. I'll tell you that much.
If things normalize, what does that mean for the tech trade? What does that mean for the broadening that we've seen in December with the equal weight outperforming the market cap weighted S&P?
Sure. On the side of tech, this is where I think expectations normalize, meaning that, hey, you're not going to get your deflationary life-changing robot tomorrow. You're going to see money hand over fist keep going into the capex side. So data centers, the chips, the things we need to get to the real deflationary effects that we expect from AI.
All right. Also want to talk to you about AI and that trade. Reports overnight that ByteDance is going to buy $16 billion worth of chips from NVIDIA. So another infrastructure announcement, another chip announcement. We seem to get one pretty much every week, if not every day. You say you're all about that capex. Exactly what does that mean? Does that mean that you're really seeing upside for the companies that are at the infrastructure level, like in NVIDIA?
Yeah.
Or do you see margin expansion, profit expansion from the use of AI and from the use of that capex?
No, I think we might see the beginnings of that, but it's really about the investment in those chips, in those data centers, the compute power that we need to get to the things that will bring on those deflationary effects that everybody is looking for. I think that's where the hype was. People think that's coming a little sooner than it really is. So all eyes on that, almost unlimited capital expense.
All right. You say the biggest opportunity for next year, it's not an individual stock or an index. You say it's leaning into the volatility.
Yeah.
What does that mean? Should you be leaning into these metal volatility? I mean, should you be buying silver, hoping that it all just works out, even though it's trading at an all-time high?
Yeah.
Well, it's pulled back now, but it was trading at all-time high just yesterday. What volatility should you lean into? Because I would think when you're talking to your clients, you're trying to navigate them through volatility.
Exactly. So, look, we don't have to go too far back. How about this? Almost everybody forgot that back in April of this year, you had a 20% drawdown in the S&P 500, right? That's the opportunity there to get in cheaply, right? That's the buy the dip opportunity. And I think you're going to see this throughout 2026. You had a lot of opportunities throughout 2025 to get your capital in play at lower prices. So if you have dry powder or you're a very disciplined investor, whether that's through dollar cost averaging or just having some kind of system in place, hey, we're down 20%. What do we do here? Okay, this is a good time to take some of that cash and put it into the market. We're going to want to look out for more opportunities like that. They seem to pop up every now and then.
Okay, with that idea, I just want to go kind of pull on that thread a bit. Real estate, worst performing sector this year. Should you be investing in real estate stocks? Oil's down this year. Should you be investing in oil producers? How do you take advantage of this volatility and some of these pullbacks that we're seeing in some parts of the market if you're not investing in things that aren't doing well? Because most people like to invest in winners, just to be real.
Yeah, absolutely. So this is where you have that opportunity to take a look at how well you're doing on the winner's side. You had an amazing year in U.S. equities. International equities actually crushing it this year. And if you're a long-term investor with time on your side and you look at oil, you look at real estate, you know that these are performers perhaps over the long term or should be part of your portfolio, there's nothing wrong with taking some of your wins and going for some things that you know are not dead forever. They'll be back. You know, people that were really bullish on healthcare earlier this year, they've been rewarded, certainly. So there's some merit to that idea. Believe it, from the FA Council. Who knew?